Hi guys, I'm Michael here. Today is another part of the video about trading psychology. So, the most important thing in trading is to get rid of overwhelming feeling of stress. You will not be able to forget about it completely, but you've got to be able to control your emotions. That's the most important thing. Hedge funds and prop trading companies are hiring psychologists and various types of managers to help traders contain their stress and to handle the emotional side of trading. Even if you had the best strategy, the most profitable one, you will not get rid of the drawdowns, and those are the most difficult things to handle. So this should be a warning sign to you that this is a very important thing, that you must not ignore the side of the learning process. And the way to contain this feeling is to get yourself prepared as much as possible. In any scenario, in any job, any sort of competition, sport, etc., the way to be confident is to be prepared. Even in school, there's a good resemblance. When you have a test coming next week, what do you do to pass it? You learn, right? You don't know the questions, but you know what it's gonna be about. So this is like in real life in trading. Most likely, you'll not know the answer to all of them, but you'll answer to most of them, which will allow you to pass the test. And what will give you the confidence while walking into the classroom on that day? Preparation, right? So the first thing when you are a complete beginner is to learn the glossary. Market slangs and concepts. You can find the easy glossary on LiteFinance website, for example, in the section for beginners. To extend that and learn even more, you can go to Investopedia and look for longer explanations of the topics. So the most important thing you have to follow is not to buy courses for beginners. Most likely, when you are beginning, you don't want to spend too much money, so you can just skip that. Listen closely because this is a money hack for you. The things you need to understand in the beginning of the journey, you can find online for free. There is no need to pay for it. Most often courses have some kind of the list of the things you will learn during the course. So you can just check them and then Google it or find the videos on YouTube and that's it. The basic knowledge is out there for free. So right now I just saved you at least $100 to $150 right there. You're welcome. Also, I need to tell you that you should question everything somebody is saying to you, even right now. Do not blindly follow somebody's advice on how to trade. Always double check things. Test them risk-free on paper trading and then you'll realize, is this something for you or not? Nobody will tell you exactly what to do on how to be successful in trading. There is always this problem of interpretation of things and tools and applying them to your trading. Even when you pay a lot of money for some exclusive training, it will be a matter of how you apply it after the course in real life. I went a bit sidetracked right now, so let's go back and talk about the next step of learning, which is to learn how the market works. So, what roles are designated to each entity on the market? How different asset classes behave and what drive the prices? I mean, of course, it's supply and demand, but what drives the supply and demand of each of them? So, the base difference between, for example, stocks is that stocks are rising assets, and the purpose of the company is to make profit, of course, and different companies will perform differently in various stages of economic cycles. So then we have commodities, which prices are also to some degree connected to economic cycles. And next are currency pairs. So they should be rather treated more as a commodity than a rising asset. I was telling you this a million times in previous video, but I will tell it again in case you missed that. So the thing is that there is no equilibrium point where the quotation of a currency is good or bad. It also doesn't mean that when a currency is expensive in comparison to other currencies, it doesn't mean that the economy of this country is doing good. And the opposite as well. The weak currency doesn't mean that the country's economy is in a bad shape. They are quoted against each other and it doesn't mean that the economy is weaker than another. Look at this example. For €1, you must pay around 1.3 US dollars. And it doesn't mean that the US economy is weaker than the Eurozone. In fact, the GDP of the US is bigger than the EU, which accounts for even more countries than the ones that used the euro as their national currency. So you should start questioning the comments of various analysts that are saying something different. If we talk about the stock market, then yes, it reflects the state of the economy. In fact, the stock market always forecasts the upcoming recession and boom in the economy, which means that the stock market will fall before the start of the recession and it will rise before the recovery and booming market. Next thing on the list is to learn correlations of different assets. For example, we have a simple correlation between currency pairs, like on Euro USD and Pound USD. Those pairs are directly correlated, which means that if one is moving up, the other most likely will follow. It is simply due to the fact that they are paired with US dollar. But there are correlations like the one between Canadian dollar and the price of oil, where also the direct correlation occurs. It is due to the fact that Canada is a fifth largest oil producer and most of their foreign exchange earnings and export earnings is from selling oil. So overall, they depend heavily on oil, and that is why this correlation occurs. So when you will see no publications on the calendar concerning the Canadian economy and some big moves are occurring on USD CAD, for example, you should check what is going on oil, because most likely it is due to some event concerning the oil market that moves the price of the CAD. The direct correlation occurs there, so when the price of oil is rising, the CAD will get stronger, therefore the quotation of USD CAD will fall. Next thing is fundamental and technical analysis. And yet again, you need to know what fundamentally drives the prices of different asset classes. What is the economic environment? And for example, for stocks are things like quarterly earnings publications, fusions with other companies, entering new markets, so on and so forth. For commodities are global demand and activity in production and transportation sectors. So for currency, for example, for currency pairs are publications of various macro data and in recent history monetary policy publications of central banks and overall central banks' decision on interest rates, a program like quantitative easing, i.e. their actions in general. As for technical analysis, first you need to start from things like support and resistance levels, supply and demand zones, even with the candlestick chart patterns, and then indicators, from the typical ones that you have available on the trading platform like MACD or moving averages, to indicators that measures, for example, fear on the market based on the market volatility, which this one is, for example, called VIX. So having that knowledge, you can start learning trading strategies, which are built based on those factors. First, what you need to do with such a strategy is just to test it. The further the backtest and the more assets you'll test, the more samples of the results you'll get. The more information you'll get, the more confident you will be during trading on the real market, because you will know more or less what you can expect, right? So this is simple. Another step is getting used to bigger transaction volumes. And here, there is no remedy except for practice, and more practice. To be able to live from trading, you will have to trade with a bigger capital and therefore bigger volumes. As always, this is a game of numbers. So to keep the risk management tight, you need to have bigger capital at your disposal. How much exactly? It depends on your expectations. And also what is important is that you need to have sorted out your finances. What I mean is that you can't start learning while having some debt burden or investing your life savings. This is not the way to decrease the level of stress while trading. First couple deposits you lose, and you need to be prepared for that. There is no other way to gain experience. I myself lost a ton of money at the beginning, more than I could even afford at that time, so I know what I'm talking about. Increase the lot size step by step. You can do it, for example, each month, each quarter, but don't do it right after a winning streak. What many of the traders do. They are having 10 trades in a row with profit, and then they are starting to double, triple, or even opening a 10 times bigger trades with having the same capital, and then losing all the profits or even more. Well, I guess that's it for the video. Let me know what is your approach for increasing the lot size of your transaction. I'm curious on that one. What are your conditions to be able to increase the size of a position? Also, remember to follow LiteFinance on Instagram and TikTok. I'm also posting stuff over there too with this kind of genre about trading psychologies and even more. So yeah, do check those accounts and thank you for watching. Till next time, guys. Take care. Bye.